All right, our next guest thinks he's found the magic number for these markets. It's 1163 if you're taking a look at the S&P 500. So what's important about 1163? That's, of course, why we have Rick Bensignor. He's an expert. He's the chief market strategist at Execution Noble. He's also put in his time as the former chief technical strategist at Morgan Stanley. Rick, good to have you with us.
Nice to be here.
So 1163. In fact, we were going back and forth emails during the day talking about, okay, I wanted a number, and you kept saying, well, there's a number, but maybe there's not a number. But 1163 looks to be an important number because it has to do with a downward trend in the market that we at least have to take note of, right?
Right. So if you have the all-time highs from the fall of 2007, if you draw a downtrend line from that peak to the peak of earlier this year in 2010 in April, that line comes in this week at 1163 in the S&P. We've told clients we think we're going to test that downtrend line, especially because just a few weeks back, a month ago, we tested the uptrend line from the March 2009 low. By the very fact that we held 1,050 so well in the S&P on multiple attempts this year, the last one being against that uptrend line, just makes sense to me with the laws of physics and the way trading kind of works. We're going to go now upward and test the downtrend line from all-time highs.
All right, but 1134, right? So we're at 1134, and you want to see if we can get up to 1163, and if we break through 1163, what do we have to do? Get new protractors and new rulers?
No, because
somewhere else?
That's just the downtrend line. There are, of course, so many different ways to measure it and create targets for the upside. One natural place to look at if we can kind of plow through this 1163 level would be this year's highs, which are 1220. And we, in fact, earlier this week have instructed clients that we've kind of got a new view on the market, and this for us is a fairly new view, that despite the general meandering markets that we expect to have for years to come, we actually think we're in a phase now that the markets will push higher and likely test 2010 highs, if not minimally exceed them. So
how did we get there? Because just a couple weeks ago, everyone was wringing their hands about the market's declines and saying, well, this rally isn't going to last. This is just going to blow off. What is giving you that confidence that thinks that, okay, we might actually test 1163 and then test those 2010 highs?
Well, recall, I think it was 2 or 3 weeks ago, we sat here together. We had talked about, and we emailed about this too after the fact, that the market was at a critical inflection point. I said precisely.
I remember you using that wonderful word, inflection.
We said that the onus was on the bulls, and the S&P was just about 1,050, to show themselves here and now. If they're going to show up this year, this was the time and place to really show what they had. Well, they did so with flying colors, and the market has moved significantly, 8–9% or so.
That's right, in a month.
In a month. Now, what's interesting to me is how fast the sentiment shift changed. Because as of yesterday morning, the Daily Sentiment Index, which was one of the polls that we look at, and it's one of our favorite polls because it polls the complete retail side of the market, non-professional futures traders. It came into yesterday at 87% bulls. Earlier in the summer, we had a conversation where it was down at about 15% bulls when we were playing with 1,050, 1,040, and the world seemed like it was falling apart. In a matter of 2 months, we have shifted all the way up to now almost 8 to 9 out of every 10 people are bullish on the market now. So I think we've probably moved up a little too much too quickly. But we've made this shift in our call to say we really are, for the first time in a while, going to take the chance that you could buy the market on a pullback. Our preferred entry point is 1120 to 1105 in the S&P. And we think you might actually get 100 to maybe 125 points on the upside while only risking 50 to 60. So from a risk-reward point of view, it's a 2-to-1 on the upside. And we think if this market's really going to go, it has tested downside enough times without really being able to break that it's probably time for a decent up move.
All right, so we got 1134 today on the close. We want to see 1163, that breakout, to confirm what you're talking about. All right, so Rick Bensignor, we've got this 1163 1163 level on the S&P 500, and the call out to the clients is get ready, maybe a little pullback, buy the pullback, then get ready. Maybe the market's going to move a little bit higher for equities.
Correct.
What about gold right now? That seems to already have been the story.
Yeah.
It just moves higher and higher. $1,246 an ounce is a number that you're looking at. Why $1,246?
Well, one of the models we look at is something called, well, it's a piece of a bigger model within the realm of Tom DeMark models. This is a gentleman who created many models that the institutional marketplace looks at. Within this model is something where each time the market closes above the close from 9 days prior, 4 days prior for 9 days in a row, it creates a new support level. It's done this multiple times, and whenever gold has sold off, it's always held the most recent time that we did this particular phenomenon.
All right, hold on. I'm just going to clarify it. So it's like a situation where you've got 4 days prior. So you take today's close, let's say, and you go back 4 days, right, and you take that number, and if you close above it, you give a little check mark, and that's happened 9 times in a row.
When you do that 9 times in a row, this pattern has been created.
Okay, and it works?
Yes, and we trade off of this, and institutions do, and it's all part of a bigger model, but it's often a critical inflection point. Once again,
I love that. In double inflections, right. That's another title.
The most recent move in gold created this from a base of 1246. And when I look back, remember when gold sold off $100, I think late spring, early summer? From what had been probably, what, 1265 to about 1150, something around there.
About 1150, 1149.
Right in there was one of these levels that had started a prior 9 count up, which we came down and tested. And I look back, and since gold has made a significant multi-hundreds of dollars moves, because gold's been so strong, every time we've sold off, we've always managed to hold above the last time it did one of these things. So recently on this surge higher, and gold is now getting close to $1,300. We've had a long-standing trading target of $1,306, so we're all getting $10 away. I looked on the charts today in preparation for this because we were talking about gold, and I noticed that 1246 was the last time this kind of base came from for this 9 count upward. And therefore, to me, when you ask for kind of a critical level in gold, I'm going to stick with December gold futures traded here in New York on the COMEX. As long as we stay above 1246, the play is still intact. And we think if gold can get through 1306, and depending upon how it gets through 1306, opens the door for a move to 1400, which we think comes within just a matter of months. And ultimately, you could easily see gold another $300, $400, $500, $600, $700 higher from here over time. I can't put a time frame on how long that's going to take, but if you put gold in $1980, and I'm not the first to talk about this, this has been widely discussed along the street, if you adjust for inflation and CPI, gold theoretically, when it hit $850 in 1980, would be the equivalent of $2,200 now. So therefore, gold, essentially what this means is there's potential huge upside still for gold.
All right, so 1306, $1,306 for an ounce of gold. That's like the first step on this point, sort of escalator. And then from there, 1400 can happen pretty quickly.
Yeah, I think by January, you could probably see 1400.
Why, as someone that looks at all these market technicals, but also manages to speak English and help us figure this out, why is this, 4-day pattern when the 9-day successive pattern check mark? Why do investors look at that particular pattern? Just because it works? They modeled it and they say, oh, well, if we look at the closing price of this particular precious metal 4 days ago, and if we close above it for 9 consecutive trading sessions, that means it's going to continue up.
This particular model Tom developed in the early 1970s. All right, so it's rather robust that it's now almost 40 years later. It's still in existence. It still works. When I first learned these models in the mid-1990s, there probably were not 25 people in the United States who knew these models. Now you're talking about thousands of institutional players. It's on the Bloomberg system. So it is something
So all the pros are looking at it, correct, and it ends up almost becoming self-fulfilling.
Sometimes, yes. Sometimes, yes. I can't.
It's got a lot of currency to it.
It does.
I'm using that because I want to do the segue to talk about currencies and talk about the U.S. dollar. We've seen the euro go higher against the U.S. dollar. Yeah. The yen higher against the U.S. dollar. Are we just going to keep saying this? The dollar sinks, sinks, and sinks?
Well, certainly the Fed. This is a market that's been down for months. It had a little pop over the summer. It started correcting again downside. And then yesterday's FOMC statement really kind of knocked the boxer who's been trying to get up, who's been slugged before, and he's got a little life left in him. And boom, he gets a big, uppercut right to the chin again and goes flat down. The amount of movement in the dollar index in the last 24 hours is huge. Yesterday's high was somewhere near 81.40, and today we're down under 80. I think we got
under
to
80. It was down under 80.
60, 79, 70, somewhere right around there. In currency terms, that's a huge move, especially for the U.S. dollar. So this supposed loved currency that is the backbone and the safety place in the world for versus many other currencies when things go wrong is not acting too well. And
does it continue? I need 10 seconds.
10 seconds. I'd say within 3 days we get a bounce, a decent bounce, because the DSI is 8% bullish right now for the dollar index.
I'm just going to use the first half. We get a bounce.
We get a bounce.
We get a bounce. All right. Rick Bensignor, Execution Noble. Always fabulous to hear your thoughts.